Welcome to the Deep Dive.
Glad to be diving in.
We're looking at Lululemon today, a brand that, usually spells consistent growth, premium feel.
Right. Top tier athleisure.
Right.
But their latest Q2 results definitely sent some mixed signals to the market.
Exactly. So today we're going to dissect why the profits actually looked, well, surprisingly good on the surface.
But that core U.S. business is clearly struggling. Big time.
And then there's this tariff bombshell, almost came out of nowhere, and it's really reshaping their whole financial picture.
Yeah, it's a major factor now.
So stick with us. You'll walk away with the key numbers, sure, but also that strategic view.
Understanding what's really driving things, and importantly, what Lululemon plans to do about it.
Okay, so let's unpack this. Quick look at the headline numbers for Q2 2025.
Let's do it.
They reported GAAP diluted EPS of $3.10. That's generally accepted accounting principles earnings per share.
And that comfortably beat the consensus estimates, which were around $2.86.
So a strong B on the bottom line, right?
Definitely. But what's really fascinating, and where the mixed signal comes in, is how that contracts with the top line.
Ah, the revenue number.
Yeah, revenue came in slightly below expectations, $2.53 billion.
Just missing the $2.54 billion consensus.
Right, even though it was still up 7% year over year or 6% in constant currency.
So bottom line beat, top line miss. The market noticed that.
Immediately.
Yeah.
And it sets the stage for the rest of the story.
We also saw some margin pressure, didn't we?
We did. Gross margin decreased 110 basis points. That's 1.1 percentage points. Down to 58.5%.
And operating margin?
That declined even more, 210 basis points, so 2.1 points, down to 20.7%.
Why the pressure there? What's driving that squeeze?
It points directly to a couple of things. Higher markdowns, so they had to discount more.
To move inventory.
Seems likely. And also the looming impact of those tariffs we mentioned. We'll definitely get more into that. It's crucial.
And critically, overall comparable sales. Yeah. Only up 1%.
Barely positive.
Yeah.
But here's where it gets really interesting, peeling back that layer.
The geographical split, right?
Exactly. America's comparable sales actually declined 4%.
Down 4% in their biggest market. Wow.
While international comparable sales surged 15%.
15%? That's a huge divergence.
It's incredibly stark. And it really is a central theme of the call. Very different dynamics globally.
Anything else in the snapshot? Inventory.
Yeah, that's worth noting too. Inventory jumped significantly. Up 21% in dollar terms.
And units.
Up 13% in units. Total value is $1.7 billion.
So more product on hand, slower sales in the U.S.
You see the connection. That puts pressure on margins through potential markdowns down the line.
Okay, so those are the headlines. A complex picture. Let's dig into the underlying forces.
Well, let's do it.
Starting with that big regional split. Management was, well, pretty direct about the U.S. and North America's struggles, weren't they?
They were surprisingly candid, actually. Admitted the company has become, and this is their word, too predictable.
Predictable? What did they mean by that?
Especially in the casual sort of lounge and social wear categories. Think scuba hoodies, soft stream, dance studio pants.
They're core franchises, the stuff everyone knows.
Exactly. And they're saying those lines just aren't resonating with guests the way they used to, not driving the excitement.
Is this just a Lululemon problem or something bigger?
Well, if you zoom out, the whole premium athletic wear market in the U.S. is, frankly, challenging right now.
How so?
Consumers are just being more selective. They're spending a bit less on apparel overall. And when they do buy, they're really looking for truly new styles.
So any sense of product staleness gets amplified in this environment.
Precisely. It makes it much harder for established, maybe slightly older lines to maintain momentum.
That's a tough assessment from management about their own products. So is anything working well in the U.S.? Where are they seeing strength?
Thankfully, yes. It's not all bad news. The performance apparel side continues to shine.
Like the technical gear.
Exactly. Categories like yoga, run, train, even golf and tennis. They're seeing growth there, gaining market share.
Any specific innovations doing well?
They called out things like align, no line, day drift, be calm. Apparently, those newer performance items are getting a strong guest response.
Okay, so that highlights something important, doesn't it?
It really does. When Lululemon does innovate effectively, when they bring real newness, the customers are there. They respond.
So the issue isn't necessarily brand loyalty fading?
Probably not. It seems more about a lack of perceived newness in those key casual categories, especially for their best customers, the ones who've been buying for years.
They need something fresh to get excited about.
They're ready to buy, but they need the right product.
So how are they tackling this predictability problem head on? They must have a plan.
Oh, definitely. They're not sitting still. They're driving a major product refresh, a big overhaul.
What does that look like?
The main goal is to significantly increase the share of new styles in their overall assortment.
What's the target?
They're aiming to go from about 23% new styles currently up to around 35% by spring 2026.
That's a pretty big jump. How are they going to achieve that?
They mentioned leveraging new design leadership. They have a global creative director, Jonathan Chung.
And technology.
Yes, and also their newly appointed chief AI and technology officer, Ranju Das. The idea is to use tech and new creative direction to speed up innovation, get new products to market faster.
Makes sense. But it sounds like a longer-term fix, right? Spring 2026 is a way off.
Exactly. It's a clear strategic pivot, but management was also clear that the most meaningful impact won't really be felt until, probably early 2026. It takes time.
Okay, so while the U.S. wrestles with that, let's flip to the international story. Completely different picture there.
Night and day, almost. The international business is still a powerhouse for them, a real growth engine.
Give us the numbers again.
International revenue overall soared 22% year over year.
And comps.
Comparable sales up a strong 15%.
Any particular regions standing out?
China mainland, for example. Revenue there jumped 25%, with comparable sales up 16%.
Still huge growth.
Yeah, it really underscores the global potential. In many international markets, Lululemon is still in the earlier stages, still acquiring new customers, building brand awareness.
The brand feels fresher, maybe, in those markets.
That could be part of it. It offers something different compared to local or established competitors there.
But wasn't there a slight caveat even in China?
Yes, good point. Even within that strong performance, management did flag some emerging headwinds.
Macroeconomic stuff.
Seems like it, particularly in the Tier 1 cities in China. That actually pushed their Q2 China revenue towards the lower end of their own expectations.
So even the growth engine isn't totally immune to broader economic shifts. A little yellow flag there.
A little one, yeah. Something to watch.
Now let's pivot to what really seemed to shake the market after the call, this tariff situation.
Right. This is a really big piece of the puzzle for their current guidance and the stock reaction.
Explain the basics again. New U.S. tariffs, yes, but the critical part was this de minimis thing, right?
Exactly. The de minimis exemption change is the real kicker here.
Remind us what that allowed them to do before.
Okay, so previously, this rule allowed companies to import goods valued under $800 into the U.S. without paying duties.
And Lululemon used this how?
They shipped a lot of their U.S. e-commerce orders, about 2/3 of them, apparently directly from Canada. Because most individual shipments were under that $800 threshold, they paid no duties.
So a massive cost advantage for a huge chunk of their direct-to-consumer business.
A huge advantage. Essentially a free pass on duties. And now, that exemption is largely gone for shipments from Canada and Mexico specifically.
Poof! Those goods now face tariffs. That must be a significant financial hit.
It is substantial. For this fiscal year, 2025, they estimate these policy changes will result in roughly a $240 million hit to gross profit.
$240 million. Wow. How does that translate to margin impact?
That equates to about a 220 basis point decline in gross margin for the full year.
So 2.2 percentage points wiped off just from this.
And they specified that about 170 basis points, so the majority of that hit, is directly due to the de minimis change specifically.
That's a material, policy-driven headwind that just landed on them.
Exactly. And it wasn't fully anticipated, at least not at this scale, in their prior outlook.
What about looking further out? Does this impact continue?
Yes. They anticipate an even larger net impact on operating margin in fiscal 2026, around $320 million from the combined tariff and de minimis effects.
$320 million next year. Are they planning ways to offset that? Mitigation strategies?
They are. They expect to offset about half of that $320 million impact in 2026 through various measures.
Okay, what kind of measures are we talking about? Raising prices?
That's part of it, but they were careful here. They mentioned strategic, modest price increases on a small portion of their assortment.
Primarily in the U.S.
Primarily U.S. focused, yes. They don't want to broadly hike prices and risk hurting the brand image.
Makes sense. What else?
Supply chain initiatives, negotiating with vendors, maybe shifting some sourcing, although that takes time.
And cost savings elsewhere.
And enterprise-wide expense savings, looking for efficiencies across the business.
But they also added a caveat, didn't they, about how quickly these benefits would materialize?
They did. Management explicitly stated, and I'm quoting roughly here, that Realizing additional benefits will take time.
So these aren't quick fixes. They can't just flip a switch and offset that $320 million.
No, definitely not. It sounds like fully offsetting it might take even longer, perhaps beyond 2026. They're playing catch-up on re-engineering parts of their logistics and cost structure.
Okay, so you add up the U.S. slowdown, the product predictability issues, and then layer on this massive immediate tariff hit.
And the natural consequence is a significant cut to their full-year guidance.
Which is exactly what they did. What's the new outlook?
For the full fiscal year 2025, they now expect revenue between $10.85 billion and $11 billion.
How much growth is that?
Only represents 2% to 4% growth year over year, or 4% to 6% if you exclude the extra week they had in 2024.
That's a big deceleration from their historical growth rates. And earnings?
Diluted EPS is now projected between $12.77 and $12.97 for the year.
So a much more cautious outlook overall.
Definitely signals the pressure they're feeling right now.
Does the new guidance break down the regional expectations?
It does, and it highlights that divergence again. U.S. revenue is now expected to actually decline by 1% to 2% for the full year.
Decline. Wow.
Canada roughly flat. But China,
Still the bright spot.
still expected to grow 20% to 25%. The disparity is really striking.
And what about the immediate next quarter, Q3? What's the guidance there?
Equally cautious, reflecting that immediate pain, especially from tariffs. Revenue expected between $2.47 billion and $2.50 billion.
And EPS.
Between $2.18 and $2.23.
What about the margin hit in Q3? That's where the tariffs really bite first, right?
Exactly. The expected gross margin decrease in Q3 is a huge 410 basis points year over year.
4.1 percentage points lower.
Yes. And they specifically said 230 basis points of that drop is directly due to the tariffs and the de minimis change.
So the full force of these headwinds is hitting them right now in Q3 and Q4. Makes the near term look pretty challenging.
Very challenging, no doubt about it.
Okay, let's pull this all together for you, the listener. What are the critical takeaways here? Why does this matter?
Well, Lululemon is clearly at a critical juncture. They're navigating this sort of perfect storm of internal product challenges, specifically in the U.S.
Predictability issue.
Right. And these major external headwinds from trade policy changes.
And the market reaction reflected that complexity, didn't it? Shares down significantly after the announcement.
Absolutely. It underscores how much weight the market put on that revenue miss, the U.S. comp decline, and especially that big tariff-driven guidance cut.
Even though the Q2 EPS beat was technically strong.
Right. The near-term outlook pressure overshadowed that beat. It's all about the future path right now.
So takeaway number one is probably that predictability issue.
Definitely. It's a stark reminder that even incredibly strong brands like Lululemon need constant innovation, constant newness, especially in a crowded market like athleisure.
And they have a plan, the product refresh, new leadership aiming for that 35% newness by 2026.
But the key phrase is by 2026. It signals this isn't a quick fix. It's a strategic pivot that will take time to show results.
Which creates this kind of wait-and-see situation for investors.
Exactly. There's a clear disconnect right now. Management is expressing long-term confidence in their plan.
But the market is laser-focused on the near-term pain, the margin compression, the weak U.S. demand.
So key things to watch going forward. Holiday season demand in the U.S. will be critical.
See if any early signs of the refresh are helping.
Maybe. Also, the pace of those new product introductions throughout next year. Any updates on the tariff impact or mitigation efforts?
And whether that international momentum can hold up.
Absolutely. And underlying all of this is that tightrope walk you mentioned earlier.
Balancing the premium brand image.
With managing these higher costs and needing to potentially clear some of that built-up inventory, perhaps through markdowns, it's delicate.
I can't afford to dilute the brand's premium feel while trying to manage costs.
It's a classic retail challenge, amplified by their specific situation right now.
Yeah.
How they navigate that will be telling.
Okay, now for our segment where we toss around some wild but maybe plausible trade ideas. And remember, folks, this is strictly for entertainment, definitely not financial advice.
Never financial advice. But look, Lululemon's situation is interesting from a trading perspective because of that tension we just discussed.
The near-term pain versus the potential long-term recovery plan.
Exactly. You've got clear headwinds now, the predictability issue, the tariffs hitting margins hard, the cautious guidance through early next year.
But you also have a clear strategic plan for a product refresh that management believes will re-accelerate growth, targeting significant impact by 2026.
Plus, that strong international growth story, even with minor headwinds.
So, how could someone structure a trade around that kind of dichotomy, acknowledging both sides?
Well, one idea, purely hypothetical, of course, could be a multi-leg option strategy, something that tries to capture both the short-term view and the long-term view.
Okay, intriguing. Break that down.
You could, for example, combine a longer-term bullish position with a nearer-term bearish or cautious one.
Like what specifically?
Maybe you'd consider buying a deep-in-the-money LEAP call option. That's a long-term equity anticipation security.
So, a call option with a long expiry date.
Right, maybe expiring way out in January 2027, for instance. Betting that by then, the product refresh is successful, the tariff impact is managed, and the stock has recovered and reaccelerated.
Okay, that's the long-term bullish part. What about the near-term caution?
Simultaneously, or around the same time, you could execute a bearish put spread with a much nearer expiry date.
Like maybe December 2025?
Exactly. Something covering the next few quarters where the headwinds are expected to be strongest. That would involve buying a put at one strike price and selling another put at a lower strike price.
Limiting your potential profit, but also your cost on the bearish bet.
Correct. So the overall idea is you're positioning for continued pressure or volatility in the near term through Q3, Q4, maybe early next year as the tariffs bite and the product refresh is still ramping up.
While also holding a position that could benefit significantly if the company executes on its turnaround plan for 2026 and beyond.
Precisely. It's a way to sort of align your trade structure with management's own timeline for recovery, acknowledging the short-term pain, but betting on the long-term game. Again, complex, hypothetical, not advice.
A fascinating, if complex, idea reflecting the current state of play.
Okay, that wraps up our deep dive into Lululemon's Q2 2025 earnings call.
Quite a call. We've seen a company really wrestling with that product predictability in its core home market.
While at the same time showing continued impressive strength internationally. That divergence is key. And the massive impact of those U.S. tariffs and the de minimis change just can't be overstated. It's directly hitting their numbers and led to that much more cautious guidance.
Management clearly has a strategic reset in motion, focusing on product innovation.
But the real benefits, as they themselves said, are mostly expected further out into 2026, which sets up a really interesting narrative for the next year or so.
It's definitely a compelling study in brand agility, isn't it? And a reminder that even the strongest market leaders face these dynamic challenges. They have to adapt.
Constantly.
How well Lululemon executes this product refresh, navigates these cost pressures without damaging the brand, that's the story to watch.
Will they turn the corner faster than expected, or will these pressures persist longer? That's the question for the next few quarters.
Indeed. What surprise awaits in their next report? That's what we'll be looking for. Thank you for joining us on the deep dive. We always appreciate you tuning in, listening actively, and staying curious.
Yeah, thanks everyone.
If you found these insights valuable, maybe share this with a fellow investor. And feel free to connect and let us know what earnings calls or deep dives you'd like us to tackle next.